All right, ladies and gentlemen, welcome back to the Simple Markets channel. My name is JB, and today I just wanted to start off with a nice quick poll. This is something I do fairly often for the members here. I try to disperse the different topics. It's not all directly Forex related. It might be related to things like investing or lifestyle. I try to expand beyond just Forex related questions. And in my opinion, being surrounded by not only a Forex trading group, but a group that is heavily focused on expanding their money and net worth as a whole, it is going to be 10 times more influential to yourself and your financials compared to a lot of those Forex groups out there that literally just teach you some trading concepts or smart money and course content and let you go off into the sunset or into the deep, dark depths of the ocean. But with that aside, as many of you may or may not know, Jerome Powell, who is the head of the Fed here in the US, finally coming in with a rate cut after, I believe, 9 months since our last rate cut. I won't go too in-depth. For those of you that don't understand rate cuts, I apologize. This is not what I'm going to be going into this video. Just wanted a short segment here. But the question that I asked my students was, when the Fed cuts interest rates, which groups are most likely to benefit? Select all that apply. And listed below is just many different asset classes that myself and many of my students invest into as well. Now, of course, you can see the majority of my students chose real estate, which in fact is correct and one of the correct answers. But the hint I will give you here on YouTube is that there's 3 other answers on this list that will increase in value typically based on historic data when the Fed cuts interest rates. Now you can go ahead and pause the video and take your guess as well. I'll give you a few seconds to do so. Now, if you guessed A, B, C, or E, you would be correct here. Let me scroll up a little bit so we can see all the answers. Now, what this means for some of you, all 4 of these are hyper available to every single person watching. On most brokers, you can start with $10 and throw it into some of these different asset classes and see, on average, based on historical data, a greater ROI on your capital due to these rate cuts being made. Of course, this is not financial advice, but just a little learning moment for some of you there looking to expand your income into different asset classes. It is super important to not have Forex trading as your sole and only income. Expand your assets, move into more passive income streams, and you can thank me later. But without further ado, the point of today's video and the title and why you likely clicked on it, we are going to be going over how to build your own trading plan. Of course, you guys know myself and every single student in the community trades our trading plan, the Simple Markets one that you can download for free below. But I understand maybe that plan is not a one-size-fits-all, and there's some people here who want to build their own trading plan. And today I'm kind of catering towards some of you, just going to kind of help you walk through that. We have a trading plan template here that kind of helps you build it step by step and understand the different variables that go into it. So the very first one here is going to be your trading preferences. Now, it is a preference because it is completely up to you here. This is up to things like your lifestyle, the amount of pairs you can manage, your attention span, all of these things will come into play. And step 1 is going to be what instruments will you trade. So deciding on the instruments you prefer to trade and write them down in your trading plan. Don't write them down on a piece of paper. Open a document like this and start jotting things down. Have it on your computer while you're viewing the charts. And in some cases, if you want, print it out, laminate it, and keep it on your desk like I did for many years. So just some examples here. Some people may want to trade Euro USD, Pound USD, US 30, and gold. It is completely variable in the Forex space what you want to trade or even indices. And as I go through this document, I'll kind of give you insight into, of course, as many of you know, what I trade and my preferences that I went with here. I trade about 28 different trading pairs, and that does kind of feed into this section we're about to go over, which is your time and session you will trade. Guys, this one is a really big one, and I really hope some of you listening can get this part through. If you are a student, which I know a lot of my subscribers are, if you are someone who works a 9-to-5 job, which I also know a lot of my subscribers are, there is no reason why you should go on YouTube and start picking up these smart money trading plans that require you to sit on the charts for a 2 to 4 hour session per day at a set time of day. It does not make sense for you, and if you cannot build it into your lifestyle, you will not see success. I cannot tell you how many subscribers reach out and say they found a trading plan from certain smart money YouTube traders out there who required you to hop on the charts during a kill zone or a set session per day, starting at 8 a.m. But they say, JB, in 4 months, I go off to school and I will be in university and I will no longer have this set window to trade. What do I do with my trading plan? The hard truth and the reality of it is you have to ditch that trading plan. It is not something that is built for you and not something that is built for the long term. This is why I found the interest in the 4-hour time frame, as well as my colleagues and all of our students. As of right now, the vast majority, if not everyone in our community, is trading the 4-hour time frame. but it's because it is essentially one size fits all and the closest you can get to one size fits all in the trading industry. We have students who are full-time workers from 9 a.m. to 5 p.m. They cannot hop on for a 2-hour session at 8 a.m. We have plenty of them who are students as well, and they might have university. We have some of them with mandatory military responsibility due to their country. We even have a student who is a professional soccer player on the Hong Kong United team, and he is absolutely killing prop firms using the 4-hour time frame because it helps fit everybody's lifestyle. Keep that in mind as we go further in this document, and the next step we are going to talk about here is forming your bias. Now, as many of you know, I assume bias is fairly optional, but there is some of you out there who may want to use it, because of course we understand that the higher time frame rules the foreign exchange market, and we work from a top-down analysis. Someone like me, although understanding that we work through a top-down analysis in the foreign exchange market, also understands that I would rather remove this large discretionary piece of my trading plan because of the amount of variables that it brings into the plan. For example, we have about 4 steps here just to simply identify your bias, and this is very common in the smart money space. I kind of built this template off of what's more common in smart money. But you're going to do things like labeling your break of structure highs and lows. You're going to mark the higher low and your target high, also known as internal and external liquidity for some people, also known as buy side and sell side liquidity for others. There is so many channels and so much smart money content out there. Don't let it confuse you. Mark your points of interest and establish your bullish or bearish expectation for the day when you go into trading. However, keep in mind there's 4 separate variables here that were used to form this bias. I even mentioned in this section here that there are traders who use a single EMA to form their bias, and it is simple and mechanical. I would much rather some of you lean towards that end of things versus the highly discretional way, because you will find some holes in your plan. You will take a trade one day and then go back to your higher time frame and say, well, wait a minute, this could have been the high and this could have been the low, and then now we should have been bearish. I shouldn't have bought here. I should have sold here. This is what happens when too much discretion is involved in your plan. So in my opinion, and for the ease of my students, we tend to cut this part out. That will be a lot easier for some of you, a lot easier psychologically, and not leave that hole in the plan where you can constantly blame something on your bias. Where there is discretion in your plan is where the excuses will mainly come from. Limit that discretion and you will have a more mechanical and simple trading plan. Next step is, of course, your entry model. Now, how will you enter the markets? The most important part of a trading plan is, of course, your entry model, and the most important part is keeping it exactly the same every single time. If you change this or you have too much variability, let's say there's 8 steps to your entry model, once again, where there is discretion, there will be excuses and losses. Having something be more simple will be more effective in the long term because it will lower the amount of psychology involved in your trading plan, as well as a multitude of variables in a checklist. I recommend something like 4 to 5 steps in your checklist. However, there are some people who might have 8 steps within step 4, enter on a fair value gap, a supplier demand zone, or a breaker block or order block. That counts as 4 different steps, and you are vastly increasing the discretion in your trading plan, leading to that inconsistency that you may be struggling with. 4 simple steps. I won't go too in depth with them, but this is your general entry model. And a little note that I leave here, where do you begin if you don't know? Take some past images of successful trades that have hit TP for you, and then start building a basic standard checklist that all of them may have in common. Let's say you have 4 winning trades in your trading career and you're just starting out. Take those 4 trades, put them side by side and say, okay, what are the similarities here? All of them had a sweep on liquidity. All of them had a break of structure. And all of them I entered on that last unmitigated candle, also known as a demand zone or supply zone for some people. And then that kind of starts building you that foundation of the list, and you can build and improve it as you please. Now, last but not least, the foundation to a trading plan, absolutely not least, the risk management of your plan. This has to be as mechanical as possible and cannot change. Your risk management, for the most part, should stay identical no matter what. This should rarely or ever change on a trade-by-trade basis, and by far has to be the most mechanical part of your trading plan. There should be 0 discretion here. So just an example, I have 1% risk per trade, no scaling. This just means that for this example purpose, this trader is going to take 1% risk every trade, and they're not going to scale up as their account increases. They might have a rule of 2 positions maximum per time if they're trading like an intraday session, for example. And then they might have some other rules like no break even or no partials. That just means that you are keeping all of your profit open on this trade and it's either a win or loss. Target your range high or low. This is very mechanical, of course, very similar to how you guys know I trade, where I have a low and high of a Fibonacci, and I always enter on that Fibonacci, and then no trading high impact news. Obviously, you guys know I operate on the 4 hour, so I can kind of ignore this piece. But last but not least, we do have some takeaways here down the bottom. Now, one takeaway I also would like to add to this, of course, we know a written trading plan is the most important aspect. We understand simplicity over complexity here because we are a simple market subscriber. And then we understand that psychology, of course, limiting the psychological effects, is to trust your trading plan through backtesting and vigorous backtesting. If you are someone watching and you have never backtested yourself, I'm sorry to say, but you are not putting in the effort that you may feel you are. Everybody watches the movie like Rocky where there's that hard grinding training montage before he goes and wins his fight, or has the victorious scene in the movie. If you are skipping your backtesting, you're trying to skip that whole training montage, throw some Rocky music on in the background if you need, and start collecting data so you can fully trust your trading plan and know that you can trade it profitably. Because I trade my trading plan profitably does not mean you can pick up that exact same trading plan and will start being profitable from day one. You will need to go through backtesting. You will see 100+ repetitions and trades if you backtest, and this will give you the absolute best foundation you can to be successful in the longer term. And of course, just a few images here provided by one of our coaches, Sven. Just a couple students he works with. We have about 2,555 trades in this session, going over about 10 years of data, just showing that slow and consistent equity curve. Of course, a little bit of a lower win rate based on the trading plan that we use. But we have some other examples here where it's closer to our average of about 34% with this plan. All of these images use our plan with that fixed 3R, so you can see the consistent profitability here over about 556 trades. And you can also see how this is 1 year of data. The key here is you, as a trader who may not be backtesting, may take this entire year to find out your results. And if this were a negative result, you would take an entire 365 days to find out that you are not trading profitably. This trader here was able to sit down probably, if I had to guess, within a week or two to collect this entire session of 556 trades, and he already has an expectation of his data. He has essentially mastered his trading plan because he has seen 556 different trades of it. He knows what his win rate is expected to be over the long term. He knows what his returns are expected to be over the long term. And lastly, we just have another example here as well, another 500 trades with a fairly great win rate. Overall, just showing that slow climb on consistency and profitability. Yes, there's drawdown periods, but yes, there's expansion periods as well. Please, if anybody is listening and this is your wake-up call today, start backtesting. It is the best thing you can do for yourself to fully trust your trading plan no matter what it is that you have developed. If you go and build your trading plan template today, the only way that you can have full trust in that is by backtesting it vigorously. And a side note as well, if you develop a trading plan or you have your own trading plan right now where you might have, let's call it 20 trades per year, I'm sorry, but I don't think that is an effective enough model for you. A lot of these smart money traders have very highly discretional plans, and it leads them to having maybe 20 trades within a whole year. If you go on a vacation, if you are sick and don't hop on the charts, if you are visiting family, any of these things, and you miss the 1 to 3 to 5 winning trades that you had that were 10 RR in that plan, you are not going to see a consistent edge because you have not built it around your lifestyle. Once again, 20 trades in the year, you can easily miss a few, and those few could be the winners that helped you achieve that profitable data. Now, I don't have this document for download right now. Our students obviously have access to it within the community. If someone wants this document, reach out to me in DMs. I'll send it to you for $100. No problem at all. Okay, I was just kidding there. But if you do really want this document and maybe you're working on building your own plan, reach out to me in DMs on Discord. It's at the beginning and end of the video. I'll just send it over for free, and it'll kind of give you a guideline or a template to kind of work off of. Or of course, if you're lazy and you don't really want to message me, pause the video, take screenshots wherever need be. Make sure to read the takeaways, and that will be all for today's video, guys. I hope you enjoyed. I hope you got some value from it, and I will see you all in next week's video.